Yeah.
Recording. Okay, there we go. It had too many options, resume and stop.
No worries.
Um, you're now co-host.
Perfect. Thank you.
All right, welcome everybody. We'll give everybody just a few minutes to log in here. But it is a nice evening. It's about starting time, and we'll get started in about 1 or 2 minutes here. I see a lot of people logging in right now. But welcome to pre-REOs, how to build wealth the way the big banks and Wall Street funds do. We'll get started in just a moment. All right. Welcome, everybody. We're going to go ahead and get rolling here. It is my privilege to be here and to welcome you. Like I say, we have plenty of people logging in here, but we're going to go and get started as it is a couple minutes past the hour, and we want to be respectful of your time. But we thank you for being here, and we're looking forward to sharing with you what we think is an outstanding investment strategy, a great way to participate in the real estate markets, and something that you may be very familiar with, or you may not. And so this is an introductory webinar on how to get involved in note investing. Again, my name is Peter Drube. I'm the Chief Revenue Officer for preREO.com. You have probably been on our site, and that's probably how you got invited here. And we're glad that you were able to make it. So specifically what we're talking about this evening is how to build wealth the way the big banks and Wall Street funds do it. And we're talking about learning to buy distressed, discounted assets, specifically mortgage notes that are currently held by these institutions, and then how to turn these mortgage notes into profits for yourself. This is something that a lot of people are semi-aware of. They kind of know a little bit about, but or some people haven't heard a darn thing about it. But it's something that not a lot of people know much about. And we've been doing it for quite some time. We do educational courses on how to do it. And we've also got a marketplace where you can invest in and purchase mortgage notes for yourself. And so we're going to talk tonight and give you just an overview, a brief introduction to how this is done. So specifically, let's talk about note investing. And what is note investing? Note investing is, again, something that a lot of people are not as familiar with as other vehicles in real estate. Most people in real estate understand the concept of buying a home, holding on to it for appreciation, selling it at a higher price, sort of the retail market. A lot of people certainly understand purchasing property and renting it out, producing income from it, whether it's an apartment building or whether it's a single family home that you rent. The darling lately has been the fix and flip market, right? Mostly because it's on TV and we all love the big reveals at the end of the shows. But most people are familiar with the idea of buying a distressed property or distressed home and either fixing up or rehabbing or building on the lot or doing something different with the property so that it becomes worth more and then reselling it. Sort of the fix and flip market is popular out there. What people understand less about is the financing that goes into all that, and the fact that there are notes or mortgages, deeds of trust, behind the scenes here that are involved with most real estate. Most real estate is purchased on credit of one sort or another, and that credit, those notes, those promissory notes can be traded. So what we're talking about is a promissory note, right? When you've taken out a mortgage or a deed of trust on your home, you signed a promissory note for the amount that you borrowed. Many times it's called a loan, although technically the note is slightly different than the loan itself, but they're interchangeable in their terms many times. We talk loans, we talk notes, and that is accompanied by a collateral file, right? Some sort of collateral that goes with that note, to be it a mortgage, a deed of trust. Once in a while, there are land contracts, slightly different, but mortgages and deeds of trust are the most common, depending on the state that you're in. Those notes, along with the mortgages and deeds of trust, are actually become assets that can be bought and sold, and in fact are bought and sold. Notes are typically bought and sold amongst banks many times over. In fact, once you originated a loan to buy a piece of property, what most people don't know is that behind the scenes, typically that loan that was originated, that note, gets bought and sold 5-6 times at least. It has to do with some indemnification for the originators and things like that. And that usually goes on without anybody's knowing on the consumer side, meaning that your note is passed between different entities. In fact, many years ago, a couple decades or more ago, there was something called MERS, or the Mortgage Electronic Registration System, that was created in order to make those transactions even easier, right? To move those mortgages along. Many mortgages wind up in funds that are securitized funds. They wind up being the backing for different retirement funds and securities and things of that nature. Why? Because they can be very, very profitable. They're predictable income with real estate as the collateral for that note. Well, when these notes go into these funds or into these banks or into wherever they wind up with different investors or different investment vehicles, not all notes perform the same way. Some of them default. Some of them, even as performing notes need to be sold, right? We've seen recent bank failures that where people had to sell their assets, right? Banks had to sell their assets. And in the process, many times these notes, whether they're performing, meaning that the people are paying on time, it's a mortgage where people are keeping up to date on the payments and everything is as it should be. Sometimes those are sold into the marketplace and typically at a discount. But most often what you see are the non-performing notes, right? Loans that have defaulted for one reason or another, typically payment. Typically people have stopped paying or they've had an interruption in their payments and they're behind on payments. Or occasionally they're defaulted for other reasons. They have not paid property taxes or they've failed to keep the property insured, things that are part of that agreement that they originally signed. When these notes go into a default, some banks and institutions have whole departments that work them out and work on collecting on that debt or foreclosing on the property. But many do not, and many simply prefer not to be involved in that business. There's a reputational risk involved in doing so, right? If I'm Bank of America, I don't want to foreclose on too many people because then my name kind of gets sullied, right? Back during the Occupy Wall Street days, there were literally people, occupying the bank lobbies of some of the major banks who were foreclosing on people. And that's a reputational risk that many banks just choose not to do. Other times it's purely a personnel issue. They just don't have the personnel to handle all of the properties and the REOs that result or the sales that result. And so often they will take these non-performing assets and sell them into the investment marketplace. Now, in the past, that investment marketplace primarily included other large institutions who would buy, 50, 100, 200, 1,000 of these non-performing notes at a time. And they would buy them for a steep discount and then proceed to work on working those out. And many times they'll even trade them more times. They'll sell them 2, 3, 4, 5 times as, they'll take off a few and work on those, but they don't have the bandwidth. Let's say I'm a bank and I buy 1,000 of these non-performing loans from one of the major institutions. And I really only have the personnel and the bandwidth to be able to work out 500 of those. I will then turn around and sell the other 500 that I can't work out, or I just don't have the personnel to do that. I'll sell it to another institution. And that's the way it's been. Behind the scenes, these notes get sold many times over amongst institutions and traded along the way. But now, because of the work of preREO and our founder, George Newberry, these notes are now available, many of them, to individual investors. And they always have been, but primarily the market that in the past has been available to individual investors has been the market occupied primarily by sellers of real estate who have carried back private notes, right? They're not the big institutional notes, the ones that came from banks, but rather seller financing. And then they've created a note out of it that is performing for a while and they'll resell that, or it's non-performing and they'll resell that. That's been a small market compared to what the banks have. But as we'll show you, a few years ago, we developed an opportunity for banks to sell to the general public, and we overcame some difficulties that they had in doing that, to where now many of these institutional notes are now available for the public to buy, for private real estate investors to buy one at a time. And so that's what we're talking about with note investing. We're talking about buying these mortgage notes. Now, again, we're going to show you some pictures of properties as we go, because it's pretty boring to show a piece of paper as the note, right? The promissory note. But don't be fooled. You're not buying property here. What you're buying is the note or the loan that was issued on that, along with the mortgage or deed of trust. And what comes with that is, as you become the holder of that note, you now have the ability to collect on that debt, whether it be through one of a variety of different means that do not include foreclosure, or by foreclosing on the property when necessary. So we'll go through all the ways that you collect on this debt, but essentially what you're doing is transacting these debts. And in some cases, it results in property that you own. often at a much deeper discount than you would have had ordinarily. And sometimes property you never could have gotten a hold of anyways. Most often, in fact, that's only about 30% of the time, most often you wind up with a payoff or a profit from just transacting this debt, buying the debt at a discount, collecting on the debt through one of a variety of means that we'll talk about. And once it's collected or once the note is resolved, then you move on to the next one. And so many real estate investors prefer this over actually buying real estate because, again, they don't have to go out and get their hands dirty with a property. They don't have to go out and deal with tenants. They don't have to go out and rehab a property. They don't have to, deal with neighbors or clog toilets or anything else like that, right? It's simply being able to profit from these notes along the way, which is why that takes us back to the title of our program. It's why the big banks and the big institutions make their money here. You might want to ask yourself, why is it that all the biggest real estate companies and the biggest banks all become lenders? They all wind up owning notes. And that doesn't mean that they originate all of that. Some of them do, but many of them simply buy and sell or trade these notes. And that's their business. And so you might want to ask, why do all the biggest investors do that? And if all the biggest investors are doing that, how can I get involved? And that's what we're doing. Last thing I'll say about note investing is that many investors prefer it because much of the work is done through third-party service providers by law, meaning that the note investor, the note holder, winds up being the quarterback of the plays, but works through what's called a licensed servicer. Servicing is something that many of you are probably familiar with because when you hold a mortgage, the person that you're actually talking to works for a servicer, not the note holder. Now, some note holders own their own servicing units, but many years ago, and for good reasons, we passed laws in our country that eliminate the opportunity for note holders, i.e. lenders, to be the strong arm that collects on the debt, right? Meaning that we got tired of having, lenders be the ones that went out and, with their henchmen to try and collect a debt and whatever the old images that you might get of the old Industrial Revolution days, that was sort of nitty gritty. We many years ago passed laws in our country that protect the consumer from that kind of occasional abuse from lenders. And so part of that law is that there is an intermediary, a licensed servicer. And that servicer has many rules that they have to abide by, reporting rules, rules about what they say and how they say it when they call people about a debt that needs to be collected. And so those servicers are what you wind up working through. So again, it removes you even more and makes it an even easier process. And then finally, if you're going to foreclose or take any legal action to collect the debt, there are obviously foreclosure attorneys and firms that you work through. So the neat thing about it is that as an investor, you are certainly managing your investments, but then you're working through these third-party service providers and being the quarterback on the play. And it's much less directly intensive, labor intensive than buying property. Now, I'm a big fan of buying property. I don't dissuade anybody from buying property and owning real estate. I've certainly been involved with that a lot myself, but note investing is much easier if you know how to do it. And that's what we're here to do, is to introduce you how to do that. Here's who we are, we are preREO.com, as in before it becomes an REO, meaning that we sell the notes before it becomes an REO property. And we're the largest online marketplace for institutional mortgage note sales. Now, right now, when you say large, we've got about 400 or 500 assets, notes for sale on preREO. We're probably at the lowest inventory that we've ever been and that we anticipate going forward. And that has to do with our economic times. Right now, the banks are kind of holding their breath, not knowing what to do. Many of them have a lot of these assets that they want to sell. Many of them are not willing to do what's called marking it to market, meaning that as soon as they do sell, they have to claim the loss or claim the amount of defaults and things like that. Many of them are not willing to do that. And if you've been following our economic times, you kind of know why. It's an interesting environment for interest rates and the economy. It's sort of tenuous. We don't know what's going to happen. And so the bottom line is that we have some fantastic assets for sale right now. People are buying and making good money on the assets that we currently have available. We expect a lot more in the near future. We don't know when. We don't have a crystal ball. I'm not here to prognosticate any downturn in the economy or upturn, But the cool thing is this is something that can be done in any market, because in any market, there are people that are performing on their notes, and the banks simply need to sell them for a variety of cash flow reasons or balancing of their books reasons. There's also in any market, even positive markets, there are people defaulting on their notes, and those notes get sold into the marketplace. So large institutional note sellers are willing to sell through us because of some of the things that we've put in place. And I'll explain those as we go forward. Some of the uniquenesses of our platform that is not available anywhere else. So while you may be able to buy some seller finance notes that are out in the marketplace from other people out there, some private note holders, we are really the only platform that brings in a lot of institutional notes for the reasons that I'll explain in just a moment. We also teach individual investors. If you're new to this, we have a couple of courses. In fact, we've got one of our fast start courses coming up. I'll tell you about on July 15th. It's a Saturday. We do that one live online via Zoom. It's several hours that we go through the basics and how to get involved. And we get we show you how to get started right away. And many people love that because they're willing to, they're the kind of people that want to jump in and learn as they go. And we certainly encourage that, but you do need a little bit of understanding in terms of fast start. And so if you're brand new to this, I highly encourage you to attend our fast start program, July 15th. You might want to mark that down. We also have a much more in-depth note investing certification course that I'll tell you more about. And that one's a little bit pricier. It's video based along with mastermind groups, but through it, we actually certify people. If you go through, complete the course, buy a couple notes with our help, then we certify you as one of our master note investors. We actually refund the tuition and then give you other perks as part of being certified. So I'll talk to you more about that as we go forward as options for you to get involved in this market. We also, besides teaching people, we're the only place where you can get financing, note-on-note financing for note purchases. You can get some, financing if you want to buy a lot of notes, and I'm talking, $20 million and up. You can go to some banks, and right now it's a little tough, but in many markets, banks are willing to finance that if you know what you're doing and you're willing to buy a ton of stuff. But nowhere in the market has it been possible, just like with homes, to buy one home and finance it. It has definitely not been possible to buy one note and finance it, but we do. So we're the only place where you get financing. We finance up to 75% of note purchases, which allows a lot of early investors, people that they're just starting out getting to know this. It allows them to get involved for much cheaper and much better ways. You don't have to finance note purchases. You don't have to finance up to 75%. I'll explain more of that as we get going, but it's an option that helps a lot of people start. We also have partners who provide license servicing and legal work. We've worked out a system where we've actually built a servicing company because we struggled with all the servicers out there to really handle the business the way we wanted it. So we built our own company, and we have a couple of legal firms that work in different states. We have one that works nationally, mostly on judicial foreclosure and some non-judicial. We have another firm that works just on non-judicial foreclosures in many states where that's the case. And so with these partnerships, we really have a one-stop shop and a way to help people get involved in this business and do it without, the normal headaches and learning curves that most people have. We provide all of the ability. And then finally, we make it easy to invest in and manage a portfolio of these, non-performing and performing notes, not only because of the service providers, but because of the platform that we have, where you can find these notes and make bids on them and work through the bids, do the due diligence and acquire these notes, and then the coaching that we offer that can help you through the process. So that's who we are, and we are the brainchild of our CEO. His name is George Newberry. George is a very prolific note investor, has bought and worked out over 10,000 different notes over the last 15 years. He started off as a prolific real estate investor who purchased thousands of residential apartment units, right? Apartment buildings. He became a real fixture in the kind of the fix up of apartment buildings throughout the country that were distressed, and became quite successful there. During the last mortgage downturn during 2008 to 2010, during the last mortgage crisis, George began buying some distressed mortgages, and he did it mostly because he had friends and partners and business people that he knew that came to him, being as heavily involved in real estate as he was, they were struggling with their own mortgages, right? If you remember during that time that, prices dropped dramatically, many people were underwater, many people couldn't pay their mortgage, and many people were looking for a way out. And he began investigating, began taking a look, began buying some mortgages where he was able to. But one of the things that he found was that it was very tough to get a lot of banks, right? The big holders of mortgages. It's easy to get individual or private note investors to sell notes on occasion. You just have to offer the right price, right? But banks have a lot of other, issues when it comes to selling. First of all, they're just not set up to do that. They're used to selling in large numbers to other institutions that they already deal with. They're not set up to work with individual investors. Part of that is that they have requirements. They have know your customer requirements where they have to do due diligence on every person that they sell to make sure it's a good investment for that person. And that takes a little bit of effort on their part. Plus, if they're going to sell to 100 different investors, that means 100 different closings, 100 different, files and closing agents and all that kind of stuff. And it's just not the business that they're in. And so as George approached them to buy some notes for people that were struggling and trying to help people work these out, he found that they were just not really willing to sell to individuals. But again, being, a heavy investor in real estate to begin with and knowing his way around, he began looking for ways to do that. And part of it was that he wound up forming a trust, right? We have what's called the preREO trust, and it's a U.S. bank is the trustee. It's a trust account, and it's not unheard of. It's something that he took from a lot of other real estate strategies out there. Many trusts are formed to buy and hold real estate on the part of investors. And so with the trust, he was able to set up a format where you can buy notes through the trust, and the banks are willing to sell to the trust because it's a known entity. They don't have to do a know your customer check on the trust. They already know them. It's, one trust, one known place. They can do, one closing or just a few closings, but it's very easy because it's all going to the same place. And it's a known quantity that hate to use the pun, but it's trusted, right? Meanwhile, individual note holders can invest, participate in the trust. Their investment goes into the trust and they get delegated authority over that note and can certainly pull it out of the trust if they would like at some point. Or many people choose to hold it in trust for a variety of reasons until they resolve the note, until the property is foreclosed upon, or until the debt is resolved and it gets paid off. And then through that trust, they receive all of the financial benefits. They also pay any fees that are associated with that note and the workout of that note. But it's proved to be a fantastic vehicle through which, hundreds, even thousands of investors have been able to invest in notes that were otherwise not open to them. He himself, as he got going on this, as I've mentioned, purchased over 10,000 different notes, formed a servicing company because, again, there was dissatisfaction with a lot of the servicers that we ran into, formed a couple of legal firms, and we developed the financing on notes, and we launched preREO. So George has been very, very busy. He and all of our team's been very busy over the last few years, but now we're in a spot where ultimately we have the ability to have individual investors, perhaps like yourself, learn about, know how to invest, know how to transact these notes, and then do it even with the help of some financing if desired. And then all of the ancillary services are there so that you don't have to go looking and figure out, well, now who do I service? Now who do I use as an attorney, et cetera, et cetera. You're welcome to do with all that, but we make it very turnkey and very easy. And so we invite you to get involved with us, and I'm going to go through a bunch of examples and show you a little bit more about how this market works and how you can profit in this market. But that's who we are. And I guess the final questions that need to be answered is, ultimately, why work with us? Why work with preREO? Well, it really comes down to gaining assets that were once held by banks, hedge funds, large note holders and lenders. Why are they willing to sell these notes at a discount? Because that's where it all matters. And the ultimate answer is that they're just not in this business. If a note defaults, especially with defaulted notes, it's not really their business in most cases to try and foreclose on that property, collect the debt. It's just not where they want to be. Other times, banks and hedge funds, they have all sorts. Sometimes they have a fund, a whole group of loans, and they're nearing the end of that fund or the end of the fiscal year or any number of things, and they've got requirements to free up cash flow at the end of the year. And so often they will take any notes that they have not worked on or ones that recently defaulted, and they will sell those instead of move them on to the next year's fund. Some of them do business in only certain states, and they'll pick up a whole tape of loans that is around the country, and they'll sell all of the ones that are in states that they don't do business in. So there's a wide variety of why banks, hedge funds, note holders, and lenders are willing to sell notes, and even at a discount, right? They sell them at a discount to get them off their books, free up cash flow, and make the numbers that they're looking to make. And usually it's a small percentage of their overall holdings, but nonetheless, it represents a large number. Again, we made it easy for them to sell because of the formation of what's called the preREO trust. And so as you buy through our platform, you can certainly buy a note out of the trust for cash and have it delivered to you, but it is always bought into the trust first, because that makes it palatable for the sellers to be able to do that. The other thing is that in about half the states in the nation, there are licenses required to do this. In other words, about half the states require a license for you to hold and enforce a mortgage. Now, not all of those states are really, really adamant about enforcing the laws that they have, but many of them do. And even the ones that, don't go after enforcement that much, you never want to be on the outside of what the law states. And so one of the beauties of holding it in trust is that the trust is licensed, or at least one of the things that all of the states have is the laws do not apply to a national bank trustee. So again, this is a U.S. bank as the trustee, and therefore the licensing laws do not apply as long as the notes are held in trust. So, which is another reason that many people choose to. And so, both because of that and the ability to to not have to deal with the licensing laws and not have to re-up on your licensing and do your CEs and pay the fees every year for licensing in a state. The bottom line is that you can simply hold it in trust and still be an investor that has all of the profits and all of the assets that are there for you. And then finally, through the trust, we're able to offer financing, and we'll get to that more as we start talking here through some different deals. I'll show you some opportunities. But through the trust is able to offer financing to the investors within the trust. And then finally, we built the servicing and legal firms just to make it easy and to run our system that has proven very successful, but also to make it easy for you as an investor to be able to invest and get all of those assets. So let's get into how you actually make money in this, right? What do you do with notes? So we're not buying the property. Again, if you tuned in a little late, I'm about to show you some slides that have plenty of pictures of properties on them, but we're not selling property. So when you see the picture of the property, just know that it's not the home or the property that we're selling. It's the mortgage note. It's the loan, if you will. It's the promissory note that we're selling along with the mortgage or deed of trust. That is a transactable asset that can be bought and sold. And that's what you're buying. And again, it's not so that you take over that mortgage. That's not what we're talking about. This is not, I do get people that call me every so often and say, well, does that mean that I'm assuming the mortgage? It used to be back when, 20 years ago, there were a lot of assumable mortgages in the market, right? You could simply sign a paper and take over that mortgage, start making the payments, right? But that's not what we're talking about. Assumable mortgages have mostly gone by the wayside. There's not a lot of them out there in the market anymore. And but we're not talking about that at all. We're talking about becoming the lender. In other words, we're talking about buying that note, which now means that all of the debt on that note is owed to you. All payments, all mortgage payments, monthly mortgage payments, all come to you, right? So we're talking about stepping into the role of the bank, becoming the bank, being the note holder. That's what we're talking about here. So how do you profit from doing this? Well, there are several strategies that we teach in our courses, and we're going to go through some examples here. We'll go through some details on each one of these, just so you get an idea of what it is like. Probably the biggest strategy is the first one, and that is that most mortgage notes are performing. And what it means by performing is that they're making their payments on time, right? The people that borrowed the money, however long it was amortized over and whatever their payments are, the vast majority of people make their payments on time. Every single month they make a mortgage payment, and every single month part of that goes to their principal balance and part of it goes to interest, and depending on how that note was constructed. And so there are many of these performing notes for sale. Many of them have always been performing. Others maybe were in default for a short time and now have become re-performing notes, either through a loan modification or because they caught up on their payments. But performing notes means that they're all caught up, right? They're paying on time. There's an expected cash flow that comes from them. So why would banks sell a performing note? Again, it has to do with cash flow. It has to do with asset allocation. Sometimes they just have too much of one thing. Other times they have to meet, a variety of things, net cap rules and things like that. As we know from the recent bank failures, Silicon Valley Bank, tipped it off, and that had to do mostly with their treasury bills, which again is sort of is like a note. But a lot of banks hold a lot of notes, and if they get in trouble cash flow wise, they've got to dump some of those notes. Now, many of them don't want to, because that means discounting them. Many of them wrote mortgages at a lower price and lower interest rate, and so now they have to discount them in order to get them sold. It's exactly like the bond market, right? If there's a lower interest rate on the bond, or in this case the note, then it goes for cheaper in order to match the current interest rates. So a lot of them are willing to sell if they have to meet cash flow requirements and things of that nature. And so there are many times performing notes that are in the marketplace for sale. And so these performing notes, as you can imagine, is the number one strategy for major banks. But for you, they can also be fantastic, a fantastic strategy. And I'll get into that in just a moment. First slide after this is we're going to deal with performing notes and how you make money on those. Many people prefer performing notes. They'll just clip the coupon, meaning just collect the money each month and earn a fantastic yield. And they just love owning performing notes. There's not many other investments that are as secure, because again, you have real estate as the collateral. The second option that we're going to go through here is that when you have a non-performing loan that you've bought, typically at a fairly deep discount, anywhere from 70 to 80%, sometimes as high as 85, but typically 70 to 80% is the going rate for non-performing loans in the marketplace. And when you get those non-performing loans, there's a tremendous amount of money to be made in modifying the loan, getting it back on track through a loan modification. Again, we don't have time to go through all the particulars of how to do that, but we'll show you some examples of where that can be very profitable to you, the note holder. Now, many notes wind up getting paid off, whether they're performing notes or non-performing loans, and they get paid off because people refinance their property, or they sell their property, or even if it's a falling market, there's a short sale involved. And if you have bought into that note at a discount, whether it was performing or non-performing, if you bought it at a discount, when that payoff comes, it represents a tremendous gain to you. You get paid the full amount that is owed, regardless of what you bought it at as a discount. And we'll show you some examples of that. Now, if it was a non-performing loan and you bought it at a deeper discount, often people will pay it off because rather than be foreclosed upon, they'll sell the property. And so that happens very often, and that entire discount comes back to you, right? Because you get paid all the way up, all the debt that was owed. In other cases, if you bought a performing note at a discount, again, it really increases the yield because now all of that discount gets amortized into the time that you've held the note. Could be a year, could be 2 years, could be 3 years, but it's a shortened time than holding it to maturity. The fourth option that we'll talk about here is deeds in lieu of foreclosure. Often people don't want to go through the foreclosure process when they reach a point where they see that, they really don't have the means to continue in this property, or they just don't want to. They will often sign the deed over to the lender in lieu of having it foreclosed upon. So that's also an option. Many times it comes along with some cash incentive that the lender offers them, a couple $1,000 maybe to sign the deed in lieu and move out. And that's also an option in many cases. And there's substantial profit to be had at times there. You can also then move on to foreclosure, and there's foreclosure that results in an auction where the property is then sold to a third party at the auction, which is fantastic for the lender because they get paid everything owed to them. We'll show you some examples there. Or finally, you can take it through foreclosure, resulting in you owning the property, what is commonly referred to as REOs, real estate owned or bank owned properties. And many people, when they first get involved in, notes, they have fantasies of owning every underlying property, right? They think, oh, I want to get a hold of that property, so I'm going to buy the note. And sometimes that's the case, but I'll show you some examples where, it's not likely, very unlikely, because you're not entitled to the property. You're only entitled to what you're owed. And we'll show you how that works out in terms of whether you get the property back or not. So these are the strategies, the 6 strategies that we'll go over. Most people only think in terms of one, that is foreclosure, but the reality is there's 6 different ways. And within each of these 6 ways, there's, anywhere from 2 to 10 different variations on these. So again, we're not going to have time tonight to go through every one of the variations, but I'll give you some examples on each one of them. And then in our courses, both in the Fast Start course on July 15th, or in our Master Note Investor course, the video-based course, and the Masterminds, we go through all of these in great detail. And we'll show you exactly how to transact each one of these, complete with all the spreadsheets and forms and documents and everything else. All right, so let's start with a discussion about performing notes, right? Performing notes, as I told you, most banks prefer performing notes. They specialize in owning performing notes. Why? Because it's a predictable return on investment. And that return on investment, when you're buying notes as an individual investor, is made up of several things. And that is that it's made up of not only the interest rate on the note and how much is being paid, right? Obviously, the principal is amortized and then the interest rate on top of that. And so you're making a predictable return on this investment. But also, if you're purchasing at a discount, that interest rate is not the entire yield. You actually wind up making more than the interest rate in terms of your return on investment. So for instance, here's an example of one that recently sold on the platform on preREO.com. This is a performing note. They had actually been in default at one point through the owner passing away, but the family quickly stepped in and negotiated a loan modification and caught it back up on the loan mod. And it's currently a performing note, has been for many months. The home price is, the value is somewhere around $200,000. The note itself, the principal balance was about $100,000, $102,000 roughly. And the note was purchased from the seller, from the bank that was selling it, for $80,000. Now you say, well, why would a bank do that? Well, again, there's many, many reasons, primary amongst them being that they're simply looking to unload cash flow. They may have bought the note from somewhere else even cheaper if they bought it during the non-performance time. So maybe they made a little bit of money on it, but often it simply has to do with freeing up cash flow for the bank so that they can move on and originate more loans with more people, right? So this particular one has an interest rate of 11%, but again, the yield is higher because of the discount. I'm not going to take the time right now to teach yield calculations. If you have a mortgage calculator, either an online one or a handheld one, and you know what to punch in, you get the yield calculations on an amortized mortgage loan. But suffice it to say that this particular purchase, the yield was quite high. It was, above 15%. That's the yield to maturity, meaning that if this note holder holds it for the entire length of the term, they're going to be making that 15 to 20% every single year. I forget the exact number it came up to, but the bottom line, it was above 15%. I think it was 16, 17%, something like that. That's what they're earning every single year on their return with the house as collateral. In other words, very safe, very secure, not going to go up and down. If it's paid off early, and in this case, probably will be, the family got it back on track, but it's at 11%. It's very likely that the family, I think if there's a son involved in this one, it's very likely that the son will refinance this note at some point. When he refinances, let's say it's a year into this, he refinances to get a 7 or 8% or whatever the going rate is right now or will be. He'll do that, and in doing so, will pay off this note. In other words, everything owed on this note, which means that instead of getting the $80,000 back that was paid, they're going to get the $102,000 or some amount of that, depending on when it gets paid off. That additional $20,000 is additional yield on the note, and so it gets you can amortize that into the time it took. If it's $20,000 in 1 year, right? That's an extra $20,000 in 1 year off of 80. That's an extra 25% on the deal, right? So the bottom line is that it goes from 15% to 40% return on investment. So banks do this all the time, right? When they buy notes at a discount and then they offer to refinance those, right, for people, they're essentially they're buying at a discount and then looking to get paid off early, which then increases their yield. So the bottom line is there's tremendous money to be made in performing notes. We do a whole, section on this in our courses, how to calculate the yield, how to get involved in it. And then the worst thing that can happen here is by the way, it's not even the worst thing, but one thing that could happen, I guess, is that this note holder defaults again. Maybe the son passes away or just loses a job and quits paying. But that's okay because you still hold this note with real estate as the collateral. In other words, you still have the ability to foreclose on this property and have the note paid off. And all of the additional fees and interest and any legal expenses and things like that all get added in. Anything you advanced on the note gets paid off in the process. So you're essentially buying the ability to to collect on $100,000, and you're buying that ability to collect on $100,000 for the 80. So it's a fantastic investment. So again, go back to the original question that I asked you. Why would all the banks, all the big institutions, all the quote unquote smart money, why do they all invest in performing notes? And you think, well, I don't want to just earn whatever 5% or 6% or 7% on my money. But what they know is that there's a lot more to be made than just that percentage. If somebody does originate with you and carry it all the way to the end, well, then yes, that's the return that you're getting. But that's usually not the case, as we know that a lot of people sell, a lot of people refinance, notes are bought and sold and paid off, and especially when you can buy notes at a discount. So we teach people how to buy performing notes at a discount, how to calculate the yield so they know what discount to pay and whether to buy things, and then how to work with this so that as you get early payoffs, it results in even better. And then if it ever defaults, how to take it through foreclosure and you wind up with the same outcome. Early payoff, great return on investment. So that's the first strategy, is performing notes. We teach a lot of it. There's a lot of performing notes available on our site, and there's a lot more available in the marketplace. We teach people where to look and how to find these. So let's talk about non-performing notes. Again, non-performing notes are those that have stopped paying. And you say, why would I ever want to buy a mortgage that stopped paying? Well, it has to do with the discount involved, right? When they've stopped paying, many banks, again, they just don't have the personnel. It's not their business plan. They've already factored in a certain amount of default in their plans. And so they're willing to just sell it low and write it off, right? And so as the note holder, the person who buys that note, there's a lot of advantages. If you buy a non-performing note, one that is defaulted, it can be purchased at a deeper discount. You're buying the ability to collect on the total outstanding debt. That is the unpaid principal balance, the fees, the interest that have accrued, all of that is all added up. Anything that's been advanced for any expenses involved with the property, all of that is part of the total outstanding debt, and you're buying that total outstanding debt, the ability to collect on it, for much cheaper. You do need a good servicer to work on loss mitigation options for you and to work out the details that we'll talk about. You do need good foreclosure attorneys. Again, we have the relationships to provide for you there. And then there are several ways to collect, and we'll go through each one of these ways as we go. It can take some time. Sometimes these are collected in, you can foreclose on properties in many areas in 6 months or less. But in many areas, it will take a year. In a couple states that are still struggling with, the backlogs from COVID and things like that, it can take a couple years or more. So it is state specific as to the time frame, but again, the results can be phenomenal no matter where. All right, so let's talk about what those results might be. First result, quickly, if you buy a non-performing loan at a deep discount, let's say 25% off the total debt, you basically have that 25% to make up. It's very rare, but there are people that manage to catch up. They find a rich uncle, or they save up, they got a job again and they're saving extra money, they're putting it towards the mortgage. They manage to catch up their payments. And we often get the idea that, okay, so I bought this non-performing note. What happens if they catch up? Does that put me in a bad spot? And the answer is no. In fact, we have the party girl on here because you should be throwing a party when this happens, not just for the homeowners who manage to catch up. That's great for them, but also for you. You actually make a ton of money when they catch up. So all of those catch-up payments come to you. You're the note holder. You're the bank now. And so if they were behind, let's say it was $100,000 note, you bought it for 75. They're behind $25,000, let's say, or even let's say it's less than that. Let's say they're only behind 5,000. But if they catch up that 5,000, that's extra money on top of their normal payments that are coming to you. So there's, right there, there's an extra 5% yield just like that. And then, by the way, once they catch up and they're performing, you can either hold that note for maturity, or you can turn around and sell that note, right? There's a robust market for performing notes. So you could sell that note for 80 or 90,000, making another 5 to 10%, right? So the bottom line is that there's tremendous money to be had if they simply catch up on their payments. So it's a win-win. Hopefully they catch up. The truth is very, very few do when they're not performing anymore. But when they do, it's fantastic. And so you win, they win, everybody wins. So step number one is to catch up. There's a couple strategies, some loss mitigation strategies that you can pursue with your servicer to help that happen possibly, and to speed that up for the few that can. And so we teach how to get that done. The second way that you could work out these notes is you buy a non-performing note and you carry out a loan modification. This is obviously best when the setback was temporary. Somebody lost a job, they couldn't pay the mortgage payment, now they've got a job again, now they can pay. And so doing a loan modification where we take the arrears, whatever they defaulted on, they couldn't pay. The most common way is to take the arrears, add it into the principal balance, redraw the note with that as the principal balance, and then you redraw the terms, current interest rate terms, or even maybe a point higher. And you often will spread out the term of the loan in order to make the payments affordable. But now you get essentially almost a new loan with the new parameters involved. So again, let's take an example. If you bought a note for 80,000 and the debt was 120, in other words, you got it for a discount, obviously. That $120,000 debt is owed to you. And if they want to modify, because now they're working again and they can, it's typical to collect some money up front. So let's say you collect just a couple $1,000s. Often you can collect 5 or 10, but let's say it's only a couple thousand. Well, that's a couple thousand more than what you would normally have paid, collected if it was performing. Then you typically will modify it with the same monthly payments, but a different term, different interest rate. And now the total owed to you is 118 rather than 180. And they begin to make payments on that for 6, 12 months. Those are all payments that are coming to you. So right away, your yield on this note is higher than just a normal performing note, because you've collected the upfront and you're now collecting monthly payments. And then you now have a re-performing note that can be sold in the marketplace. Since it's a $118,000 note, perhaps you can get 100,000 out of that. That's a nice, good discount, especially if it's got a good interest rate and you're discounting it. That creates a fantastic yield for the person buying it. And there's a robust market for that. So now suddenly you've bought something for 80, you collected several $1,000s over that first year, and then you resold it for $100,000 or for 20,000 more. So again, fantastic returns on these loan modifications, depending on the parameters and what you do them for, and of course making sure that the people qualify and it works out. So loan modifications, a couple different ways of going about that. We provide you all the spreadsheets, all the ability to do that. You have to work through the servicer, but again, we show you how to do that and how to make it work. So that's the second strategy for non-performing loans. What do you do to work these out and collect on the debt? Now, the one that is fairly common, especially in today's day and age, and that is that we have a lot of equity in properties, right? We've had quite a property run up. I have no crystal ball as to whether that's going to start sliding or whether it's going to hold or whether it's going to keep going up. I don't know, right? I see arguments on all sides there. But what I do know is that we have a lot of equity in property out there, and often you're buying defaulted notes that where not as much is owed as what the property value is. So rather than have it go through foreclosure, it makes total sense for the owners of this property to go ahead and sell the property because they have equity. They could walk away with cash. Why wouldn't they, right? Rather than having it foreclosed upon and possibly losing the property and all equity, they could now sell and keep the equity. If there's a way to refinance, that's also a possibility. Often their default makes it tougher to do so, but if there's a lot of equity, possibly. here's an actual example. We've shown it a couple times if you've been on here for other programs, but this is one up in New York. Again, this was a death case where she had paid down on it for many years and then she passed away. Her family, the estate, got it ready and sold it about 9 months later. But again, it was a defaulted note when she passed away, and the bank simply wanted it off their books. So one of our students, one of our investors, bought this note for $63,400. At the time, there was about $75,000 owing on it. So again, they got a discount. It wasn't a huge discount, but there was so much equity that everybody knew it was going to get paid off. So they bought it for $63,400. Now the carrying costs and fees, in other words, they paid a little bit in legal fees to start a foreclosure, simply to get things moving and prompt the sale. They also paid a program fee. We charge a commission to buy, and then there's what are called servicer fees, right? You've got to pay your servicer each month. But this one sold 9 months later, $430,000. What was owed to the first lien holder, the note holder, which was our student at that point, at the time of sale. So this included additional interest, additional fees that had accrued in the 9 months, and the advances that they had made on some of the legal work and things like that. What was owed was $81,932, basically $82,000. And so that $82,000 over the 63 that they had invested, minus a few expenses that they had to put out, ultimately created a $14,000 profit, which was a 21% gain in 9 months. Now, this investor chose not to finance it. They paid in cash. And had they financed it, it probably would have been a bigger percentage gain on the money that they put in, bigger cash on cash return. But in this case, very healthy return in 9 months. They never had to, in fact, this investor never even visited the property, never had to go out there, never had to do anything with it. The estate was taking care of it. It was pretty much understood that they were preparing it for sale. All they did was have to prompt it along by getting some legal paperwork going and starting that. So many get paid off, and they get paid off through a variety of means. And when you get paid off, the full amount of the debt to the first lien holder, that's you, gets paid off. Now, sometimes they don't get paid off and they go to foreclosure. So that's the next category. Here's one in Yuma, Arizona. In fact, this investor just completed a second one after doing this one. The second one took a little bit longer, but this one was his first deal. It transacted in 6 months, actually took about 8 months for everything to settle out. But they purchased this property, not the property, the note. The property was about $194,000. The note was going for $135,000. And in this case, they paid a commission, a program fee. They did choose to finance it, meaning they only put $33,000 down. Now, our financing is such that we finance just about anybody. We don't do extensive credit checks. You can finance up to 75%. Again, the reason that we're willing to do that for just about anybody is that the property also serves as collateral for that note, meaning that you must hold it in the trust if you're going to finance it. We finance through the trust, and the property, if you ever default, the note I'm talking about, the asset, the mortgage note is in the trust, and ultimately becomes the collateral for your loan as well. So because of that, we're willing to finance up to 75% for just about anybody. That 75% doesn't have to be the total. You could do 50% or 25%, whatever is needed. And then ultimately, it's essentially hard money rates. You can do it for 1 year, 2 years, 3 years, depending on how long you think this deal is going to last. And it's 12%, 12.5%, or 13%, respectively. In this case, they chose to finance for 1 year. It was 12%. Interest only. The principal balance is due at the end of it, meaning that when you settle out your whole transaction, you pay it off. There's no prepayment penalty on the financing. In other words, if your deal only takes 3 months and you're done, you pay it off early, there's zero penalty, right? So you're simply paying interest-only payments per month. On the 1 year, 12% per year, it's only 1% per month you're paying. And so, he did that. He financed $101,000. It got to auction 6 months later, went through the foreclosure process, wound up at a foreclosure sale. And at the auction, it actually went for higher. The property had gone up in a little bit in those 6 months. It went for $222,000. The net proceeds to the first lien holder were $191.5, right? Meaning that even though the property was worth more at the time, all that was due on that mortgage, including interest and fees and everything else, was 191, 584. So what got paid to this first mortgage holder, the person that bought this note, was the total owing the lender, 191. Obviously, they paid off the funding along the way. I lumped them in here. There had been interest payments they had been paying. And so along the way, they had paid a little bit more. And the bottom line is that their total was 107, including all the interest payments and the payback of the loan. The bottom line is they made about $47,000, which was 100% return, a little bit more than that, based on the money that they put in during the whole program, during the transaction. So huge win for them, doubled their money, and fantastic deal. And by the way, this property went on to, the person who bought it at auction was somebody that went on to fix it up and resell it again, right? So it turned into a rehab property for somebody else. But in this case, the note holder never had to deal with trying to rehab it, never had to clean it out, never had to go there, and nothing like that. So a great place to be. This is why banks get involved in this. A couple other examples here. This is one that was in Florida, non-performing loan. Again, they chose not to finance this one. They bought it for $52,000. More was owing on it, and they took it through foreclosure. In this case, it did not get bought at the foreclosure auction, but wound up as an REO. Now, along the way, there were some fees, there were some legal costs, there were some tax liens that hadn't been paid on it. All of that got paid by the note holder. But in the end, they wound up with a property. Now, they had first gone into this thinking they were going to rehab it, but when they got the property, they got offers from others and they realized the market was there. So they turned around and sold it for $86,500, which was a $20,000 profit. So again, had they financed, maybe it would have been a greater cash on cash return. But for them, it was about a 30% profit, and they could sell it and not have to do any rehab. They didn't really worry about doing that. Took about 18 months, and in Florida, it takes about a year to foreclose. And in this case, there were a couple other delays. This started off at the tail end of COVID, and so there were some delays in getting that rolling. Normally takes about a year in Florida to get things done, but 18 months in this case because of the COVID backups and things like that. So again, great opportunity, great property, good note that was transacted without having to own the property. Two more examples here. This is one where they purchased the note, $105,000. They did finance it. They'd only put $26,000 down. They financed $78,000. Again, some costs along the way, including the financing costs. At the foreclosure auction, it went REO. In other words, the lender got it back. Now, once they got it back, right, it was held in trust. They had financed it in trust, but they wanted to pay off the financing for the note itself. And they wanted to ultimately fix up and rehab this house. And so they literally at that point had their business entity, one of their partners, their LLC, buy it out of the trust in order to pay off the note and get it ready for rehab out of their own LLC. So they wound up with a property for much less than what they could have bought it normally. And the potential investor profit, they proceeded to fix it up. We've asked them where they haven't told us, but they told us it was above 30,000 they wound up with. Took them about 20 months to do, start to finish. And again, fantastic return on investment. A property they might not have otherwise been able to buy, except that they bought the note first and took it through foreclosure. And then finally, here's a creme de la creme one. They don't happen often, these higher priced ones. And obviously it takes a certain amount of moxie to do these just because of the amount involved. But this one was Singer Island in Florida, $1.8 million, very nice property. And it was, again, coming out of COVID, the person, the owner was in bankruptcy and actually had a tenant in here. And the bottom line is that it was in foreclosure. He put, in this case, he also financed it through us. The note buyer bought it for 1.8, put down 400, financed 1.36. And there was a program fee, the commission that we charge. Legal fees were not that high in Florida. They're not that high to foreclose. There was a tenant. And so when they wound up with the property as an REO, they did wind up paying that tenant to vacate early, right? There was a lease and they paid them $25,000. In this case, obviously a high dollar amount, but it was what they were paying anyway, so it was appropriate. Now, this particular investor decided, well, I'm gonna spruce it up. 250,000 seems like more than a spruce up, but again, consider the property. They really didn't put that much in compared to the value of the property. And at the time, they thought they might be able to get. They had kind of thought it was probably in the 2.5 million range and 2.5. They were expecting a decent profit, but nothing unheard of. But when they put it on the market, and you can still go see this one out there on Zillow or Realtor or any of the others, it sold for $3.8 million, which means that their whole, take, start to finish, buying the note, winding up with the property in foreclosure, fixing up the property, and then reselling it was $1.3 million, a little bit more than that. This particular investor bought several more with us, as you can imagine, but said it was the most profitable real estate transaction of their entire career, and they've been in real estate for quite a while. So again, these things happen. They happen all the time by buying notes, and this is what we teach. So here's my final questions. We're running out of time, and I'll get to some Q&A here. But important questions to ask yourself is what if these examples had been in your portfolio, any of them? And we have hundreds of other examples, right? Notes that have been paid off early, notes that you bought for a good yield, and then they paid off early, so you got even better yield, or notes that you took through foreclosure and they were sold at auction, or notes that you worked out a loan modification and then resold that note. Phenomenal. So what would it be worth to you to learn how to find, purchase, manage, and profit from this kind of investment? I would suggest that it's worth quite a bit of money. Now, I will tell you that, like any other real estate investment, not knowing can cost you money, right? This is not something where everything goes up and you make money on every deal, but you mitigate those losses by learning how to evaluate, how to analyze, how to buy the right notes for the right price, how to stand your ground and not pay more than what you should for the notes, and ultimately then how to manage that investment through to any one of the outcomes that I've talked about. This is what we teach, right? We do a complete course on note investing, Note University. It's our Master Note Investor course. And as I told you, we're doing our Fast Start course as a preview of it coming up on July 15th. But our Master Note Investor course is a video-based course. You can go through it as quickly as you want, along with mastermind sessions. They happen weekly that you can attend, as well as individual coaching along the way. We're not going to take all the time to go through every detail of what's in the course, but it's very exhaustive. Goes through everything having to do with the people and lending and the transactions themselves and how to do it. So at the end of the day, what's this worth, right? What do you pay for this course? Well, it's definitely worth the tuition, especially since we refund it when you get certified. If you complete the course and you buy a couple notes with us, we will refund the tuition. We have quite a number of people about ready to be certified. We launched this course back in late January, and we have several people that are on the cusp of certification. In fact, several that we're going to be awarding very quickly that have already gotten there. So again, tuition is free, plus several other bonuses we don't have time to go through right now. So here's the bottom line on the course. It's $14.95 if you pay up front. It's 3 payments of $5.95. We've even opened up a 12-month payment plan if you would like. There's zero reason not to get involved financially. And even better than that, we currently have a Fast Start program that can give you more for just $89. So here's how you get to the course itself on preREO. You can go under the Learn tab and you can click the Note University here as it drops down. Or there's a big banner when you first pop onto the site, right underneath the main header that says Master Note Investor Certification Course. And that big banner is one that you can click on, and it'll take you right to the course registration page. And then as I've been saying, finally, we have, and we'll send you out the link, but you can also go to our Note University pages and get there. But we have on July 15th, you want to circle that date, it's a Saturday. We are doing a 6 total hours, that includes breaks. So there's going to be about 4.5 hours worth of instruction via Zoom, live questions answered, live discussion, actually showing you how to get started, how to get the basics down in terms of, setting up an offering for notes, finding notes, purchasing notes, going through the due diligence, getting that all transacted, and then getting set up to start working these notes out for profitable resolution. So I invite everybody to join us for that $89. If you're already an enrollee in the Master Note University course, you get this for free, right? We're going to send out a code for everybody for free. But if you're not, pony up the $89 and join us there. And you may have plenty of knowledge and be able to get rolling simply with the Fast Start course. So that's my spiel, but there's some questions to answer. So I'm happy to answer those questions. And the way that gets done is we have both a Q&A panel as well as a chat panel. And I'm willing to go to either in order to pull out questions and get rolling on those. So go ahead and type your questions into there. I will start answering questions as they come in. I do see one right away that was already in here. A little unclear about the short sale. Aren't we the note holder now? How can the bank who sold the note to the trust do a short sale if we're now the note holder? The answer is you're not selling the property, but you are accepting a short sale in many cases. In other words, let's say that I am owed 120,000, but the property is only worth 100,000 right now, and I'm foreclosing on it. The owner of that property, the person who bought the property is the owner of the property who owes the money, owes 120,000. They may come to you and say, okay, I want to sell this property rather than having you foreclose on it. Will you accept a short sale? And the answer is up to you, right? You as the lender get to approve that short sale or not. You're not the one selling the property short, but you're approving a short sale, in which case you're basically saying, okay, I'll take less than what I'm technically owed because my collateral is only worth that much. And so I'll go ahead and do that, right? Even if I got the REO back, if I did a deed in lieu or or it went through foreclosure and I got the property back, I'm probably not going to be able to sell it for more than what it's worth in the market. So accepting a short sale is often a really good strategy, especially if you only bought that note for 75 or 80,000, right? So if you bought it at 80,000 and the short sale is at 100, you're still making $20,000 out of it, plus, whatever's been paid to you in the meantime, right? So the bottom line is short sales are something that we don't see a lot of lately because property values are up quite a bit, but they do happen, and you can accept short sales or short payoffs as the lender. Just like if you went to sell your property and you have a mortgage on it, you would have to talk to the bank before you could sell it short, right? Well, in this case, if you've bought the note, you are the bank. So hopefully, Wayne, that answers the question. If not, chime in again and I'll answer further details. Conrad says, can preREO purchase notes of properties if I provide the necessary information? The answer, so there's a couple facets that can we purchase the notes of properties? So if you simply go out and find a property and say, okay, that property looks good, can we go buy the mortgage? The answer is probably not, because the millions of mortgages, that hundreds of thousands of mortgages that are out there are held in various entities, securities, etc. The vast majority of mortgages get securitized, and they're the backing for retirement funds and things like that. And so getting at those, especially if they're a performing note, those security funds, typically, you can't just go to them and say, hey, I want to buy this particular note. They typically won't sell it. It's part of their fund. They're not going to break out the fund and sell one note, right? So typically, that's not the way you can go about it. Typically, what you're doing is that the funds themselves are bringing a certain amount of mortgages to market, and they're selling 100 at a time or 200 at a time. And those we can certainly buy, but I can't pick one property out of a neighborhood and just simply go buy the note, typically because it's held behind the scenes. Now, sometimes it's possible. If the note is currently held by a private investor or a local bank, or even one of the banks, or if it's in default and the bank is selling it, sometimes you can find that note and buy it, but it's not a guaranteed thing. So not typically. Henry Speed III, I took this course through Lee Arnold. Does this count towards the July 15th class? The answer is no. So we love Lee Arnold. It's not the same course that we offer. The course that we do is much more in-depth and detailed. And the $89 Fast Start will give you a lot of details that were not there, but also is just part of our ecosystem as well. So jump in, join it. I promise you get quite a bit out of it. and we love Lee Arnold and his courses, but very different in terms of our approach. What if it is non-performing? Again, Conrad's asking, what if it's non-performing? Again, same thing. It's more likely if it's non-performing, but not a guarantee, because there's hundreds, thousands of different funds that have mortgages in them. Whether or not that fund is selling those mortgages at this point, some funds, they do have a small team that works out defaults on their own. Most of them don't, but again, trying to pinpoint which fund holds which mortgage and then trying to offer them. You can chase that down, and sometimes you can make that work, but it's rare. Most of the time it happens the other way around, meaning that they're selling and we take what they're selling rather than us finding a property and trying to get them to sell it. Many times that's not possible, even if it's not performing. Sometimes it is, though. Like I said, sometimes if you do the, as a matter of public record, who the note holder is, sometimes if it's a local person or bank, sometimes you can approach them and get them to sell. Or if it's a fund in the marketplace that we're used to dealing with, sometimes we can go get it. So don't give up on that, but just know that it's not common, right? It's not common to be able to pinpoint one and go after it. All right, Sherry, nice to talk to you. We've spoken before. Do you still get all the perks with the $89 fast track course? And when is it scheduled for, if this is what I decide to do? So July 15th is when we're doing it. That's a Saturday. We're doing it on July 15th. We'll do others in the future, obviously. Do you get all the perks? Well, again, there's a reason that our Master Note Investor course is $1,500 and the fast track is $89. We're not going to cover everything. We won't have the time to do it. And certainly all the perks, all the additional, bonuses, if, once you're certified and all the things like that, no. But the fast track will get you up and running. It'll get you understanding notes and being able to make offers, both on performing and non-performing notes, and then understanding how to do the due diligence. There will be a lot of things that obviously we can't fit into those hours, but we certainly invite you to do both. And if nothing else, if you've got some background, some knowledge, attend the fast track and that'll get you up and running. And for a lot of people, that's enough to get them started, and they have enough knowledge that they can figure out the rest as they go. I recommend the certification course just for everybody, just because it'll save you money. It's very in-depth on note investing and all of the formulas and all the spreadsheets and all the stuff to do that way. But the fast track will get you up and rolling, and many of you do have enough background in notes and real estate that the fast track will be a really good way to get rolling. Okay. All right, I think I'm not seeing too many other questions, but if there are any, please reach out to us. You'll be getting an email following up this tomorrow morning. It'll have links to the fast track registration as well as other things that we do, to both the certification course and the fast track course. And you can certainly give us a call or email us anytime, or go on to preREO, take a look at some of the assets and start making some offers. I look forward to seeing you there and speaking with you when you do. With that, have a wonderful evening, and we will hopefully be in contact soon with everybody. Talk to you soon, everybody. Take care.